Hello Business 202. This accounting video is a follow-on video to the Chapter 3 video that shows the effects of journal entries on the financial statements. This video shows the opposite. What would happen if the journal entries that were supposed to be made at the end of the period were omitted from the financial statements? The setup is the same. The journal entries that should have been made will appear on the left, and the effects of the financial statements would be shown on the right-hand side of the spreadsheet. In this case, the account would be overstated if it appears as a positive value. We would indicate that the account would be understated if the entry were omitted if we enter a negative amount. So, let's see how this works. The first journal entry indicates that supplies expense are increased and supplies are decreased because some of the supplies were used up. Specifically, from the trial balance that is unadjusted, you'll find this from Exhibit 9 on page 110 of your textbooks, the supplies account originally had $2,000 associated with it, and at the end of the period there were only $760 of supplies. Now, if this journal entry were omitted, this supplies account would not be reduced to its correct balance of $760. So what would happen to the financial statements if supplies were shown at this amount, $2,000, instead of its correct amount, $760? Well, supplies would have been overstated by $1,240, and this entry for expenses would not have been made, and so that means that expenses would have been understated by $1,240. So we will enter a negative amount to show the understatement in expense. As before, we will check to assure that debits equal credits at the end of each analysis, and we see that they do not, so we must enter the secondary effects. If we have understated an expense, taken too little from revenue, we would have overstated income, and the overstatement in income would overstate owner's equity. Okay, so the omission of this journal entry overstates assets, understates expense, and shows too much, an overstatement of income and owner's equity. Let's take a look at Transaction B. In Transaction B, the insurance expense adjusting journal entry was omitted. So we would not show enough insurance, and we would show too much prepaid insurance. Prepaid insurance is an asset, and not making this credit to the prepaid insurance account. Let's just take a look at the financial statement for prepaid insurance. You can see that the balance is $2,400, and we would not have reduced it by this $200 amount. So the prepaid insurance would have been overstated in the amount of $200. And not making the debit to insurance expense would have caused an understatement of the expense. If we understate expense, we overstate income, and we overstate equity. So the effect of omitting entry B would be to overstate overstate assets, understate expense, and overstate income and equity. Let's examine Transaction C. Okay, in examining Transaction C, we would have omitted the entry making a debit entry to unearned rent, a liability, and a credit entry to revenue, a revenue account. So let's examine the trial balance to see how this would affect the financial statement. In this case, the unearned rent, which is a liability, the unadjusted balance shows a $360 amount. It's a credit balance. If we omitted this $120 debit, which reduced unearned rent, a liability, would be overstated by $120. So let's enter a positive 120 in the liability column. If the credit to rent revenue was not shown, rent revenue would not have enough credits in the account, and so rent revenue would be understated by $120. If revenue is understated, net income would be understated, as well as owner's equity being understated. So since the balance sheet assets equal liabilities plus owner's equity balances, the effect of omitting entry C would be to overstate liabilities, understate revenue, and understate income and equity. Let's examine transaction D. Transaction D, we assume that we omit a journal entry that would make a debit side entry to accounts receivable and have a credit to the account unearned or fees earned. Examining the unadjusted trial balance for accounts receivable, the unadjusted balance is $2,220, and if we would omit this debit to accounts receivable, this $2,220 would be too small. So we would have understated by $500 the total assets. If we omitted the credit to fees earned, we would have too little in the revenue account. So let's enter a negative $500 in revenue. And if we understate revenue, we would understate income and we would understate earned capital. Since the balance sheet balances, we are complete with this transaction. In transaction E, the entry shows a debit side entry to wages expense and a credit side entry to wages payable. Examining the unadjusted trial balance, wages payable does not appear in the trial balance, so we can assume it has a zero credit balance. Omitting this entry crediting wages payable implies that the liabilities would be understated. There's not enough of them. So we will enter a minus $250 in the liabilities. Expenses are increased with debit side entries. If we forgot to make this debit side entry to expense, we would have understated expense by $250. The understatement of expense would have overstated net income because too little would be deducted from revenues, and if income is overstated, earned capital is overstated. Since the balance sheet balances, we have explained the effect of omitting entry E, which would be to understate liabilities, understate expenses, and overstate income and equity. And finally, let's examine transaction F. In transaction F, we are recording the depreciation. Depreciation expense receives a debit side entry. The account accumulated depreciation receives a credit side entry. Accumulated depreciation is a special account that tracks the credit side entries that normally would be made to the asset account, equipment in this case. So business owners would want to track using the asset account the amount that they commit to the resource, and then they use the accumulated depreciation account to track how much of that resource has been used up to date. Let's examine the unadjusted trial balance and see the balance sheet effects. If we would omit a credit to accumulated depreciation, we would not have shown that some of this office equipment, which has a balance of $1,800, would have been used up. So this $1,800 balance in the asset office equipment would be too big. So assets would be overstated by $50. If we omitted a debit side entry to depreciation expense, we would not have enough in the expense account, so the expense account would be understated. If we understate expense, we have taken too little away from revenue and accordingly would overstate the net income. And if we overstate net income, we have overstated the earned capital. Now, since assets equal liabilities plus owner's equity in our spreadsheet, we are complete in explaining the effect of omitting a depreciation entry. And that is, we would have overstated assets, understated expenses, and overstated income and equity. Now, let's take a look at the cumulative effect of all that we have done. Remember that owners are very acutely aware of what their income is. And when auditors adjust their income, they pay close attention. So, if the business had omitted these 6 adjusting journal entries, income would be overstated by a cumulative amount of $1,120. So, if the original income from page 110 shows an unadjusted income of $8,225, the original income plus the overstatement of $1,120, that means that the income should have been, in this case, $7,105. If the $8,225 is too big and we overstated the amount $1,120, the correct amount should be less, $7,105. That's it for this accounting video. Thank you for watching.